London, July 31st, 1914. The floor of the stock exchange is louder than usual. Not the sharp, rhythmic shouting traders are used to, but something uneven. Voices crack. Papers slap against wooden desks. A clerk wipes his hands on his vest, then does it again, slower this time, as if the sweat might stop if he's deliberate about it. A runner pushes through the crowd, breath short, collar open. He hands over a note, no ceremony, just a nod. The man who reads it doesn't speak. He folds it once, twice, slides it into his pocket. Then he turns, not toward the trading pit, but toward the exit. Others notice. They stop mid-sentence. A few follow, not rushing, not yet. Across the room, someone laughs too loudly. Another man pulls at his cuff, staring at the board where prices had been chalked just minutes ago. Numbers already smudged, rewritten, crossed out. Outside, carriages jam the street. Messengers collide, papers scatter. Somewhere, a woman argues with a bank clerk behind a narrow counter. He keeps repeating the same sentence, slower each time. Inside, the exchange officials gather near the center. No announcement at first, just a bell. Then another. Trading, suspended. Not for the day, not for the week, indefinitely. So here's the question no one asked out loud in that moment. Was this the beginning of a war? Or the end of something that had already been breaking long before the first shot? By the time that bell rang in London, the system wasn't reacting to war. It was reacting to pressure that had been building for years. Look at the numbers, not the headlines. Between 1870 and 1913, European bank deposits didn't just grow, they ballooned, roughly 4 times larger. Gold reserves barely doubled. The gap widened quietly year after year, hidden behind polished annual reports and confident speeches. In Paris, discount rates crept upward in early 1914. Not dramatically, just enough to make bankers hesitate before extending credit. In Berlin, interbank lending tightened. Loans that used to roll over smoothly started getting questioned, then delayed. In London, bills of exchange, once treated like near cash, began to circulate more slowly, passed hand to hand with a pause. Small things on a subtle, but systems don't collapse all at once, they stiffen first. Behind closed doors, balance sheets were being adjusted, assets reclassified, losses deferred. Colonial loans, Argentina, the Ottoman Empire, sat there, still marked at optimistic values. Railways overbuilt, steel capacity oversupplied. Property in London, trading at prices no tenant could justify. And always the same constraint sitting underneath everything. Gold. Every note issued, every deposit promised, was ultimately tied back to a finite reserve. No expansion without it. No flexibility. No margin for error. So banks did what systems under constraint always do. They stretched. Reserve ratios slipped. Liquidity thinned. Confidence carried the rest. Until it didn't. By mid-1914, withdrawals weren't massive yet, but they were different. Larger accounts, quieter clients, instructions delivered in private rooms, not at public counters. No panic in the streets, just movement. And in a system built entirely on the assumption that money would stay where it was placed, that was enough. On the mathematics no one could admit. A ledger lies open under lamplight. Ink still wet. Columns of deposits stacked neatly on one side, reserves on the other. Shorter, thinner, almost embarrassed by comparison. No one points at it directly, but everyone sees it. By 1913, the imbalance wasn't theoretical anymore. It was structural. Deposits across major European banking systems had expanded by roughly 300 to 400% over 4 decades. Gold reserves? Maybe 70 to 80%. On paper, it still worked, because it always had. Fractional reserve banking depends on one quiet assumption. Not everyone asks for their money at once. But here's the mechanism most people miss. The system doesn't break when withdrawals spike. It breaks when confidence shifts just enough that banks start preparing for withdrawals before they happen. That's when behavior changes. Banks stop lending to each other. Not publicly, quietly. Maturities shorten. Collateral requirements tighten. Interbank trust, this invisible backbone, starts to thin. And once that happens, the math turns against everyone simultaneously. Because every bank's liquidity is someone else's asset. One institution hoards cash, leads to another, loses funding. Leads to a third, can't roll debt, leads to asset sales begin. Not dramatic, not at first. Just a series of small refusals. And in a tightly linked system, refusal spreads faster than panic. By early 1914, interbank markets across London, Paris, and Berlin were already stiffening. Rates didn't need to spike dramatically. The signal was subtler: hesitation, a question where there used to be none. That's how systemic risk actually moves: sideways, not downward. 2. The gold constraint, a system that couldn't breathe. A central bank vault, iron doors, rows of bars stacked in geometric precision. Cold, still. Above ground credit expands, below ground gold does not. That was the constraint. Under the gold standard, every expansion of credit ultimately had to reconcile with physical reserves. Not immediately, but eventually. And that eventually is where pressure accumulates. Here's the trap. Banks expand deposits during good times. Loans increase leads to economic activity. Rises leads to optimism, feeds more lending. But gold reserves grow slowly, tied to mining output and international flows. So the ratio stretches. At first, it's manageable. Then it becomes necessary. Eventually, it becomes dangerous. Because once depositors or other banks start converting claims into gold, the system doesn't adjust gradually. It contracts violently. Central banks knew this. That's why they competed for gold. Not cooperatively, aggressively. When pressure rose, they raised interest rates to attract gold inflows. That sounds stabilizing. It isn't, because when multiple countries do it at the same time, liquidity drains globally. Everyone tightens. No one relaxes. The result? A synchronized contraction. By 1913 to 1914, gold was being pulled inward, into central banks, into reserves, out of circulation. That hoarding behavior reduced the effective money supply precisely when the system needed flexibility. Banks couldn't expand to meet withdrawals. They couldn't print freely. They couldn't absorb shocks. So they did the only thing left. They relied on confidence, which is not a reserve. It's a delay mechanism. 3. The illusion of asset quality. A folder closes too quickly. Someone adjusts their cuffs, conversation shifts. Not because the assets are good, because acknowledging they aren't would trigger something worse. European banks had spent decades financing expansion: industrial, colonial, infrastructural. Railways in South America, sovereign loans to empires already struggling to collect taxes. Real estate developments built on projected demand, not actual occupancy. On paper, these assets produced returns. In reality, many were deteriorating long before 1914. Take Argentina's crisis in 1890. It wasn't an isolated event. It was a warning. Sovereign risk had been mispriced across continents, yet lending continued. Why? Because stopping would expose existing losses. So banks extended, refinanced, reclassified. A non-performing loan doesn't appear suddenly. It fades, payments delayed, terms adjusted, values maintained formally, until liquidity forces recognition. That's the key mechanism. In stable conditions, losses can be hidden through time. In unstable conditions, losses must be realized immediately. And realization is what banks feared more than anything. By early 1914, institutions weren't just exposed, they were entangled. The same sectors: overbuilt railways, saturated steel industries, inflated urban property markets, appeared across multiple balance sheets in multiple countries. So if one market corrected, it wouldn't stay local. It would transmit, quietly at first, then all at once. 4. The pre-panic phase. Movement without noise. No crowds, no shouting, no headlines. Just doors closing earlier than usual. In London, large depositors didn't line up at counters. They scheduled meetings. Transfers were arranged discreetly. Funds shifted, not out of the system entirely, but into perceived safer institutions, shorter maturities, more liquid forms. That's how early-stage crises actually look, not panic. Selection. Insurance companies began refusing to underwrite certain financial instruments. Not publicly announced, just declined. Risk models adjusted behind closed doors. Interbank lending volumes dropped. Not because no one needed liquidity, but because no one wanted exposure. This creates a feedback loop. Reduced lending leads to tighter liquidity. Tighter liquidity leads to higher perceived risk. Higher risk leads to further reduction in lending. No single trigger, just compression. By mid-1914, the system wasn't collapsing yet, but it was losing flexibility. And once flexibility disappears, stability becomes an illusion. Because the system can no longer absorb even small shocks. And then came the shock. Not financial, political. But by that point, the financial system didn't need a large trigger. It needed any trigger. 5. War as system override. August 1914. Mobilization orders move faster than money. Railways fill, not with goods, but with troops. Governments stop calculating budgets in peacetime terms. Urgency replaces constraint. And overnight, rules change. Gold convertibility suspended. Stock exchanges closed. Debt repayments deferred. Not debated, not gradually introduced. Just stopped. Here's the mechanism most people underestimate. War didn't fix the system. It replaced its rules. Under normal conditions, banks had to maintain liquidity, honor gold redemption, mark assets realistically, at least eventually. Under wartime conditions, those requirements became secondary to national survival. So constraints disappeared, and with them, the immediate pressure. Governments stepped in, not as regulators, but as counterparties. They guaranteed liabilities. They absorbed risk. They issued debt at unprecedented scale, and banks bought it willingly because sovereign backing replaced uncertain private returns. This created a transformation. Private risk converted into public obligation, not through conspiracy, through necessity. But the effect was the same. Banks that had been holding questionable assets suddenly had an exit. Swap them for government bonds. Extend credit to the state instead of to failing private ventures. Defer losses indefinitely. And because the entire system moved together, no single institution was exposed. The war provided justification for monetary expansion, cover for balance sheet adjustments, a captive borrower, the state, with unlimited demand. And perhaps most importantly, it removed the need to maintain the illusion of gold-backed stability because survival no longer depended on convertibility. It depended on coordination. And coordination under crisis can do what markets cannot. Delay recognition, restructure obligations, and keep a system functioning, even when its underlying assumptions have already failed. New York, September 2008. A different room. Glass walls. Screens everywhere. No paper this time, just numbers flickering, updating faster than anyone can read. A man taps his pen against the desk, stops, checks his phone. No message. He looks up when someone says, "They're not rolling the repo." Silence, not panic, not yet. Just that same hesitation. A century apart, and the pattern doesn't look so different. In 1914, interbank trust thinned before anything visibly broke. In 2008, it was the same mechanism. Banks stopped trusting collateral, stopped trusting each other. LIBOR spreads widened. Overnight lending froze. Not because money disappeared, but because confidence did. Then came the override. In 1914, gold rules suspended. In 2008, mark-to-market relaxed, emergency lending opened wide. Different tools, same function. Absorb shock, delay collapse. Fast forward again, 2020. Empty airports, silent streets. But financial markets move violently. Treasury yields collapse. Corporate bond spreads explode. For a moment, brief, sharp, the system locks. Then central banks step in. Not gradually. Immediately. The Federal Reserve buys corporate bonds for the first time. Liquidity facilities appear almost overnight. Balance sheets expand by trillions. Same structure. A shock triggers instability. Markets stop functioning normally. Authorities suspend constraints. Private risk migrates onto public balance sheets. It doesn't matter if the trigger is war, mortgage defaults, or a pandemic. The mechanism repeats. Not because it's planned. Because the system, once large and interconnected enough, has only one way to respond when stress exceeds its limits. It pauses reality, rewrites the rules, and keeps moving forward, but heavier each time. A bank counter, any year, any country, it always looks the same. Polished surface, quiet voices, numbers that feel solid because they're printed cleanly. But the structure underneath never really changes. What these episodes show, 1914, 2008, 2020, isn't just crisis. It's how systems behave when they reach their limits. Not collapse immediately. First they adapt, then they transfer pressure. And the direction of that transfer matters. Upward into larger institutions that can absorb it. Outward into public balance sheets that can carry it longer. And silently, through inflation, currency dilution, or delayed liabilities, back onto the people who assume stability. That's the mechanism. So the practical takeaway isn't prediction, it's positioning. Liquidity matters more than yield when systems tighten. Because in every case, the first thing that disappears isn't value, it's access. Markets freeze, withdrawals slow, assets that look tradable become conditional. Diversification matters, but not just across assets, across systems, jurisdictions, time horizons. Because when rules change, they don't change everywhere in the same way, at the same speed. And most importantly, understand what a guarantee actually is. In stable periods, it looks absolute. In crisis, it becomes flexible. Terms shift. Timelines extend. Real value adjusts. The pattern is consistent. Risk doesn't vanish. It moves. The only question is whether you can see where it's going before it gets there. Back to London. That bell. It didn't announce a beginning. It marked an interruption of rules, of assumptions, of a system that had already stretched too far. The war didn't create the pressure. It revealed it. Then it redirected it. That's the pattern. Not destruction, but transformation under stress. And each time it happens, the system doesn't reset to what it was before. It carries the weight forward, larger, more complex, more dependent on the next intervention. So when you hear that markets are stable, that risks are contained, that systems are resilient, pause, look at what's being held together, and ask the same question they didn't ask in 1914. What breaks if the rules stop changing?